The world stands on the brink of a financial revolution, driven by the very resource that has powered the last century, oil. But the rules of the game are changing faster than ever before. Welcome to the era of the multipolar energy order. Before we dive into the complex web of global energy and finance, make sure to subscribe to our channel for more in-depth documentaries. Your support helps us bring you the most accurate global insights and predictive analysis. Between 2026 and 2030, the global landscape is undergoing a fundamental shift. We are moving from a unipolar, dollar-dominated system to a fragmented world where energy trade defines the new financial borders. For over 50 years, the petrodollar system was the bedrock of global stability. This security for currency arrangement ensured that oil was priced exclusively in US dollars, cementing the greenback's status as the world's reserve currency. But that era is closing. Today, we are witnessing the structural peaking of demand in the West, the plateauing of the US shale revolution, and a profound reconfiguration of international finance as producers decouple from the dollar. For decades, the petrodollar recycling loop funneled energy revenues back into US treasuries, funding American deficits. As producers shift toward other currencies, this critical source of demand for the dollar is drying up. Our first key point is the rise of the petro-yuan. China, through its 15th five-year plan, is aggressively pushing to settle its massive energy imports in yuan, utilizing the M-Bridge blockchain project to bypass traditional Western banking networks entirely. China's strategy is driven by energy security. By diversifying its payment systems and accelerating electric vehicle adoption, Beijing is insulating its economy from Western sanctions and choke point risks. The 2026 Middle East crisis became a definitive turning point. As conflict strained regional supply lines, the world realized that the ability to control choke points was no longer just military, it was financial. During the peak of the crisis, the partial closure of the Strait of Hormuz led to selective interdiction. Tankers bound for the West faced delays, while those bound for the East moved through green corridors with relative ease. This green corridor was more than a shipping lane, it was a financial safe zone. By settling in yuan, producers and buyers avoided the dollar-linked risks that were inflating insurance costs and blocking traditional trade. This led to the emergence of bifurcated markets. Buyers using the dollar faced a war premium, while those willing to settle in Chinese yuan through these corridors enjoyed significant safety discounts. Second, strategic choke points are being weaponized as financial leverage. The ability to grant or deny passage to tankers based on their settlement currency has fundamentally altered how oil price risks are calculated globally. Saudi Arabia, once the pillar of the petrodollar, is now at the center of the global pivot. No longer tied exclusively to the West, the kingdom is adopting a flexible model to maximize its market share and financial autonomy. With a massive spare capacity of over 3 million barrels per day, Saudi Arabia acts as the world's central bank of oil, using its production volume to stabilize its own revenues against the backdrop of a multipolar market. The third key point is the resilience of OPEC+. By coordinating production cuts and unwinding them strategically, this alliance ensures its members retain financial leverage, even as they diversify their national reserves away from the dollar. In the United States, the shale revolution has hit a plateau. By 2026, production levels have stabilized, marking the transition from an era of explosive growth to one of disciplined, cash flow-focused maturity. A wave of corporate consolidation has left a few large operators in control of the Permian Basin. Their focus is on investor dividends and debt reduction rather than the drill-at-all-costs strategy of the past decade. Fourth, the US has evolved into a mature market. While it remains a global leader, its ability to act as a swing producer is diminishing, limiting its power to suppress prices during global supply shocks. Washington is not standing still. The Federal Reserve is exploring its own digital dollar initiatives and strategic financial countermeasures to maintain the dollar's liquidity in a world that is increasingly looking for alternatives. Russia has completed a permanent pivot to Asia. Sanctions have rerouted over half of its energy exports to China and India, creating a resilient, albeit dependent, trade corridor through the Arctic and East. Supported by massive projects like Vostok Oil, Russia's production remains robust despite Western bans. However, this shift has permanently tied the ruble to the financial infrastructure of the East. The fifth point is the formation of a permanent Russia-Asia axis. This decoupling from Western markets is creating a parallel energy economy that operates entirely outside of traditional US and European financial reach. Europe, meanwhile, faces a period of structural fragility. The loss of cheap Russian gas and the volatility of global oil prices have forced a rapid, expensive transition that is straining the Eurozone's financial stability. As Europe relies more on spot market LNG, its industrial competitiveness is being tested. The financial burden of energy imports has become a primary driver of inflation across the continent. Point 6 highlights Europe's struggle. The continent is undergoing a painful recalibration, trading its former dependence on pipelines for a volatile, globalized energy market that demands high financial premiums. New producers are also entering the fray. Guyana and Brazil are seeing an unprecedented boom in production, providing a critical non-OPEC plus source of supply that is reshaping regional financial flows in the Americas. In Africa, nations like Nigeria and Uganda are pushing for greater energy independence. By refining their own crude and exploring local currency settlements, they are attempting to break free from the traditional petrodollar constraints. India has emerged as a critical neutral player. By importing discounted Russian crude and exporting refined products to the West, India is maximizing its financial position while maintaining ties to both the East and West. The expansion of BRICS Plus is accelerating this financial fragmentation. These nations are increasingly using local currencies for trade, further reducing the world's reliance on the US dollar for commodity settlements. The seventh point is the quest for financial autonomy by the Global South. BRICS Plus nations are no longer just oil producers or consumers. They are builders of a new, decentralized financial infrastructure that bypasses Western control. At the heart of this revolution is mBridge, a blockchain-based system that allows for real-time, peer-to-peer settlement between central banks. This is the technical infrastructure for a post-dollar world. The mBridge platform supports multi-CBDC interoperability, allowing for the direct exchange of local currencies without the need for a bridge currency like the dollar. This significantly reduces the cost and time of international oil trade. By bypassing the SWIFT network, nations can trade oil without the risk of their financial transactions being blocked or monitored by foreign powers. This is the definition of financial sovereignty in the digital age. Our eighth point is the digitization of energy finance. These new platforms are making the commodity-for-currency model more efficient, more private, and entirely resistant to external political pressure. The transition is not without pain. Global inflation, driven by volatile energy costs, is pressuring central banks from Japan to the UK, leading to unprecedented currency fluctuations and interventions. We see this impact in the Japanese yen, which has become a proxy for global energy prices. As import costs balloon, Tokyo has been forced into massive market interventions to protect its financial stability. By 2030, the global monetary system will no longer rely on a single reserve. Instead, a multipolar order is emerging, where oil-backed currencies and digital assets share the stage with the traditional dollar. The 1970s model of security for currency is being replaced by commodity for digital settlement. This shift rewards those with physical resources and the technical ability to trade them autonomously. Looking toward 2030 and beyond, the oil landscape will be characterized by structural tightness and a definitive shift in power toward the producers and the technical architects of the new financial world. Even as we move toward a greener future, the financial power derived from oil today is funding the energy systems of tomorrow, ensuring that the current oil giants remain the financial titans of the next era. The US dollar will not disappear, but its role will be diminished. It will become one of many tools in a more complex, less predictable global financial toolbox. To summarize, we've seen the rise of the petro-yuan, the weaponization of choke points, the resilience of OPEC+, the maturation of US shale, and the technical revolution of digital blockchain settlements. As oil continues to control the financial pulse of nations, the question remains, who will lead the next era of global prosperity? One thing is certain, the old rules no longer apply. The world has changed, and there is no going back. Thank you for watching. If you found this documentary insightful and want to support high-quality independent research, please support us by liking, commenting, and subscribing to the video. Your support makes these productions possible. See you in the next one.